Sir, please start.
Okay, thank you. Good morning to all of you students, and I welcome you for this session of Management Accounting. Topic transfer pricing is concerned. Now you see, there are two words which are actually being considered. One is transfer, another one is pricing. Now, pricing means to arrive at the selling price. And in order to arrive at the selling price, definitely we are required to calculate the total cost, and then we are going to add the profit. Then we are in a position to arrive at the selling price. That is called pricing of products. It may be new product, it may be existing products, depending upon the situations. Now, when I am talking about market or markets, we are generally operating in buyer's market. So, the price that an organization is going to charge that will be very much dependent on the buyers. So we are in buyer's market, apart from monopolistic competition. Now, when I'm talking about transfer, and if it is related to pricing, then transfer pricing means when in an organization, say there are two units, unit A, unit B. Unit A is manufacturing a particular product that may be transferred to unit B, and at what price the transfer should be made, and to arrive at that price is known as transfer pricing. Now, if you look into the presentation, transfer price can be defined as the price charged for products exchanged in international transactions between sellers, also known as transferors, and buyers, also known as transferees, who belong to the same organization, usually a decentralized organization. Now, I am giving more emphasis on the very perception which is known as decentralized organization. Organization may be centralized, organization may be decentralized. In a centralized organization, HO, that is head office, is controlling all the units, and decision making are vested to the top executives, which are sitting in a head office. That is called centralization. But decentralization means when there is a proper delegation of authority from the higher level to the lower level, making that particular person responsible to whom the authority is actually being delegated. So, transfer pricing mechanism definitely is practicable, or it is applied in a decentralized organizations. What is called decentralized organization, I have already explained. And in the context of decentralized organization, each manager of a division is responsible for investment made, cost incurred, revenue to be earned, profit to be earned, so on and so forth. And each manager of each division can make his own decision making so that his or her division's profits are maximized, and also the profits of the buying division is also maximized, and that will lead to overall fulfillment of objectives of the company. Now, a transfer price is that notional value at which goods and services are transferred between divisions in a decentralized organization. Now, I am giving emphasis on notional value. Say, if division A is transferring certain goods at an unit price of rupees 100 to division B, then the revenue of division A, that is selling or sales of division A, will be the purchase of division B. So selling and purchasing cancels out. Nothing will come under the head office. So that's why it is called notional value. A transfer price is that notional value at which goods and services are transferred between divisions in a decentralized organization. Now, in a divisionalized companies where profit or investment centers are created, they are likely to be interdivisional transfer of goods or services, and this internal transfer creates the problem of transfer pricing. Now, assume the manager of division A is transferring certain goods to the division B, and at what price the transfer should be made, that is to be taken into consideration, considering divisions as investment centers, divisions as profit centers, etc. And pricing of goods which are transferred by the transfer division to the transferee division are to be priced, and the question of transfer price will arise. Now, in such companies, a satisfactory system of transfer pricing is necessary for measuring the performance of divisions. Transfer prices are normally set for intermediate products. Now, let me tell you what is the meaning of intermediate products. Supposing department A or unit A or division A is manufacturing certain item for which there is no external market. Okay. Now, that is called intermediate product. Say, division A may be manufacturing a ball pen head. So that ball pen head is not available in the market. It may be treated as an intermediate products, which are goods and services that are supplied by the selling division to the buying division. Now, once the transfer is made, then buying division is going to manufacture a complete product, and that product is actually being sold by the buying division to the outside market or outside world, which are known as final products. Now, there are certain objectives which should be fulfilled while devising a transfer price. And it will be termed as objectives of transfer pricing system. A question arises as to how the transfer of goods and services between divisions should be priced. So that is a big question. If, say, transfer and division is actually fixing a very high price, and if this is actually being used by the transferor division as a transfer price, then the buyer division or the transferee division will object. Okay. Now, on the contrary, if we consider transferor division is transferring the goods at cost, then it will be profitable for transferee division, that is division B, but manager of division A will have no motivation to transfer the goods because he is not having any profit. So that's why a question arises as to how the transfer of goods and services between divisions should be priced. Now, the price charged to the interdivisional transfer of goods and services is revenue to the selling division and cost to the buying division. Therefore, the price charge will affect the profit of both divisions. Benefit, that is revenue to one division, can be created only at the expense of the other division. For example, the selling division will benefit from charging higher prices for such transfer of goods and services. However, for the buying division, this will result into higher cost. So the transfer prices thus can have impact on the evaluation of performance and measures applied for such measurements of performance. Now, basically, at the time of determining the transfer prices, a number of criteria or objectives that should be fulfilled. Because from transfer pricing, you will be having both theoretical as well as practical questions. And if you do not understand the basic perception which is involved in transfer pricing problems, you are not in a position to solve the problems that will be given in the examination. So you have to understand the basic and you have to apply these concepts so for solving the problems are concerned. Now, I have said a number of criteria or objectives that should be fulfilled. Amongst these, the number one is transfer prices should help in the accurate measurement of divisional performance, because at the end of the year, the performance of both the divisions will be measured. So, transfer prices should help in the accurate measurement of divisional performance, that is profitability, for both the transferor and the transferee division. Second point is transfer prices should motivate the divisional managers into maximizing the profitability of their divisions and making decisions that are in the best interest of the organization as a whole. And the third point is transfer prices should ensure that divisional autonomy. So what is the meaning of divisional autonomy? Divisional autonomy means no higher authority is going to influence the decision of the divisional managers. They will be having the authority to take independent decisions. That is called divisional autonomy. So that's why I have said transfer prices should ensure that divisional autonomy and authority is preserved. The main purpose of decentralization, I have already told you that without having the concept of decentralization, there will be no question of any transfer pricing that can be taken into consideration. So, transfer prices should ensure that divisional autonomy and authority is preserved. The main purpose of decentralization is to enable divisional managers to exercise greater autonomy and to measure the overall results achieved on a profit center or investment center. Now, why we are giving emphasis on profit center or investment center? Because in a division where investment is made not only on fixed assets, but also in working capital, the manager should ensure that the minimum desired rate of return that may be obtained by his or her division. So, profit center concept is very, very important in the context of investment center, or where the investment is made in the context of net fixed assets plus current assets minus current liabilities, or net fixed assets plus net working capital. It is therefore not proper to give divisional managers authority by one hand by placing them in charge of divisional operations, and to remove that authority by dictating transfer prices that affect the performance of the division. So, gist of this is transferor divisions manager and the transferee divisions manager should have some divisional autonomy, and they can work independently, and no higher authority can influence their decision-making process. That is the concept. Fourth point is transfer prices should allow goal congruence. Now I am giving emphasis on the term goal congruence. Goal congruence means, say, division A is the selling division, division B is the buying division, and divisional profits of both divisions A and B are maximized, and thereby the fulfillment of overall objectives of the company that can be achieved, that lead to goal congruence. So, transfer prices should allow goal congruence to take place, which in effect means that the objectives of divisional managers are compatible with the objectives of overall company. Okay, so if divisions A's profits is maximized, division B's profit is maximized, so that overall goal congruence and overall profitability of the organization can be increased. Now, the last point, so what the objectives are concerned, a transfer pricing system, if properly established, can check multinational companies and international groups which may try to manipulate transfer prices between countries in order to minimize the overall tax burden. Now, this you are going to study in your direct tax and international taxation in your final level, and the precise concept is that in a multinational transfers, say X is an Indian company located in India having a branch in USA. Now they may involved in such a manner in pricing the goods at a lower price so that profit is actually being decreased. Okay, so this transfer pricing mechanism also can be used in the context of taxation. Okay, so the idea is, if Indian company having a subsidiary in UK or USA, then the Indian company may price certain goods at a very lower price so that their total sales are decreased and tax burden is also decreased. So that is the manipulation. Okay, so international transfer pricing in the context of taxation is actually being meant for that no company can manipulate uh, the profits and also minimize the overall tax burden. That cannot be done. Now, uses of transfer prices. Now, number one is evaluation of divisional managers' performance. Obviously, so transfer prices will be a cost of the division receiving the goods and a revenue for the division supplying the goods. So, just as managers are assessed on their management of cost from external suppliers, they are also assessed on their ability to control internal cost. This can lead to disputes between divisional managers as they try to protect their own interest and achieve optimal performance of their own divisions. Second is to achieve the overall organization goals I have already discussed. This is also known as goal congruence. Transfer prices in theory should be set to ensure that organizational goals such as profit maximization are achieved. Although divisional managers are being assessed on their own division's performance, their overall objective should be to ensure that their behavior supports the achievement of organizational goals. Transfer prices should be set at a level that encourages trade between divisions rather than driving divisional managers to purchase the goods from external suppliers. And thirdly, to preserve divisional autonomy. So if the divisional autonomy is not actually being maintained, then definitely the question of transfer pricing will not arise. So divisional autonomy refers to the right of a division to govern itself, that is, the freedom to make decisions without consulting a higher authority first and without interference from a higher body. Transfer prices are particularly appropriate for profit centers because if one profit center does work for another, the size of the transfer price will affect the cost of one profit center and the revenue of another. Now we are coming to transfer pricing problems. Number one, maintaining the right level of divisional autonomy. So it is always not feasible to maintain the divisional autonomy, and this is nothing but is the problem of divisionalization. Now, if the divisional authority is not actually being maintained, then managers of that is manager of both the divisions, that is selling and buyer divisions, they will not be motivated to make the transfer. So that's why maintaining the right level of divisional autonomy is very much required. The task of head office is to try to prevent dysfunctional decision making by individual profit centers. To do this, head office must reserve some power and authority for itself, and so profit centers cannot be allowed to make entirely autonomous decisions. Just how much authority head office decides to retain will vary according to the circumstances. A balance should be kept between divisional autonomy to provide incentives and motivation and retaining centralized authority to ensure that the organization profit centers are all working towards the same target, the benefit of the whole organization. In other words, the division should retain goal congruence. What is goal congruence? That I have already said. Next, ensuring divisional performance is measured fairly. So there will be fair way or fair approach to measure the divisional performance of both the, that is, transferor and the transferee divisions. Next, ensuring corporate goals are met. So obviously, right from the beginning, I'm telling you that in a transfer pricing mechanism, the price should be fixed in such a manner that selling division's profit is maximized, buying division's profit is maximized, and overall company's profit is also maximized. That is the meaning of ensuring corporate goals. Now we are coming to the most important phenomena, that is general transfer pricing rule. Remember, in mathematics, we are going to apply a plus b whole square, a minus b whole square, the formula. Now, in transfer pricing, although there is no fixed formula that can be applied, because it varies. The transfer pricing will be varying depending upon the circumstances of each case. But there is a general transfer pricing rule. What is that? Management objective in setting a transfer price is to encourage goal congruence among the division managers involved in the transfer price. A general rule that will ensure goal congruence is given below. Now, in order to achieve the goal congruence, a general transfer pricing rule is actually being established. Transfer price is equal to additional outlay cost per unit incurred because goods are transferred. So additional outlay cost means you are required to incur variable costs if there is a transfer, plus opportunity cost per unit to the organization because of the transfer. Now let me explain this. Say, if manager of division A is willing to transfer 1000 units to division B, then automatically whatever costs which are actually being incurred by division A, that should be taken into consideration, plus opportunity cost. Opportunity cost here means there are two basic characteristics that the cost should have. Number one, resources are scarce and each resource should have an alternative use. Okay, say division A is going to transfer certain units, say 1000 units to division B. Now the question is, at what price it will be transferred? The answer is additional outlay cost per unit incurred because goods are transferred. That is additional cost the company has, division A is going to incur for the transfer of the goods, plus opportunity cost per unit to the organization because of the transfers. Now, opportunity cost here means if division A is actually being also selling goods in the market at a market price and not an intermediate product, then if manager of division A is going to stop external sales and wants to transfer that, then there will be a loss of contribution. So that loss of contribution will be the opportunity cost per unit to the organization because of the transfer. So the general rule specifies the transfer price as the sum of the two cost components. The first component is the outlay cost incurred by the division that produces the goods or services to be transferred. Outlay cost will include the direct variable cost of the products or service and any other outlay cost that are incurred only as a result of the transfer. Okay. So let me repeat once more. The general rule specifies the transfer price as the sum of two cost components. The first component is the outlay cost incurred by the division that produces the goods or services to be transferred. Outlay cost will include the direct variable cost of the product or service and any other outlay costs that are incurred only as a result of the transfer. The second component in general transfer pricing rule is the opportunity cost incurred by the organization as a whole because of the transfer. What is opportunity cost? An opportunity cost is a benefit that is foregone as a result of taking a particular action. So, to be an opportunity cost should fulfill two essential properties. One is resources are scarce and each resource should have an alternative use. Just for an example, supposing division A is manufacturing 1000 units and selling it to the external market. Now, if manager of division A willing to transfer this 1000 units to division B and going to stop the external sales, then any contribution which is actually being made per unit for selling outside, that will be stopped, and that will be an opportunity cost so far division A is concerned. So that's why I have mentioned the second component in the general transfer pricing rule is the opportunity cost incurred by the organization as a whole because of the transfer. An opportunity cost is a benefit that is foregone as a result of taking a particular action. So if you are going to withdraw yourself from the external market and willing to transfer the goods to the division B, then you are required to say stop external sales, and in this process you are going to lose certain contribution. That is the opportunity cost. Now, ideal transfer price. What is that? Number A, the transfer price should provide an artificial selling price that enables the transferring division to earn a return to its efforts and the receiving division to incur a cost for benefits. Obviously so. Number B, the transfer price should be set at a level that enables profit center performance to be measured commercially. This means that the transfer price should be a fair commercial price. Third, the transfer price, if possible, should encourage profit center managers to agree on the amount of goods and services to be transferred, which will also be at a level that is consistent with the aims of the organization as a whole, such as maximizing company profits. That is overall goal components. Now we are coming to methods of transfer pricing. Transfer price may be of different types. The number one is at cost or variance of cost, namely actual manufacturing cost, standard cost, then full cost, and full cost plus markup. So transfer price may be at cost or different variance of cost. For example, actual manufacturing cost, standard cost, full cost, and full cost plus markup. So there are different transfer pricing methods. Each item or method of pricing having certain advantages and disadvantages. Second one is at market price. So if market price exists for the products that are actually being transferred, then it will be at market price. And third, if number one and number two, either of the two is not applicable, then there is a concept called that is bargained or negotiated price. So manager of the two divisions will sit together and automatically they will just negotiate a transfer price that will be both beneficial for the transferor divisions manager and also the transferee divisions manager. Okay, so there is no particular A plus B whole square formula. Transfer pricing to be said, it depends upon case to case basis depending upon the situations. Now, there is another concept that is called dual prices. What is that? There is a seldom a single cost based transfer price that simultaneously meets the criteria of goal congruence. Management effort, sub-unit performance evaluation, sub-unit autonomy if desired. As a result, some companies choose dual pricing, using two separate transfer pricing methods to price each inter-division transactions. Under dual prices of transfer pricing, selling division sells the transferred goods at a market or negotiated price, that is market price, or cost plus some profit margin, but the transfer price for the buying division is a cost-based amount, preferably the variable cost of the selling division. The difference in transfer price for the two divisions could be accounted for by special centralized account. So there is a dual price. This system would preserve cost data for subsequent buyer departments and would encourage internal transfers by providing a profit on such transfer for the selling divisions. Now, this dual price definitely is going to provide motivation and also overall goal congruence. Now, we are coming to the summary. Transfer pricing policy aims to drive the divisions who are more inclined to act in their individual self-interest and consider their own cost, prices, and market opportunities toward behavior that is best for the organization. Economies of scale, synergy. Synergy means 2 plus 2 is equal to 5. 2 plus 2 is equal to 5. Your effort, my effort, if these two efforts are combined, that is going to give the total of 5. 2 plus 2, that is not 4, that is 5. That is called synergy. And saving transaction cost motivate divisional managers to conduct transactions within the company, etc., etc. Now, we are coming to guidelines for an optimum transfer pricing system. So these are all guidelines, remember. Negotiated transfer prices are likely to have greater appeal to managers because of the dynamic business environment in which rapid responses and flexibility provide a definite edge. If market prices are used as a base for evolving transfer prices through negotiations, long-run competitive market prices should be used. If divisional managers are allowed to buy or sell a small quantity, say 5 to 10% outside the company, it gives them an awareness of the supply and demand conditions of the market, which facilitates negotiation of transfer prices by them. Internal disputes should be referred to a transfer pricing coordinator or arbitrator. The latter should resolve this dispute with the involvement of divisional managers. If outside sourcing is proposed, this should be reviewed by the corporate controller's office based on the financial data presented by the supplying and the buying divisions. The controller must then make a recommendation on sourcing and pricing to the operating management group. A cluster of divisions formed into a group under the charge of a vice president in each organization or to the corporate management. Corporate or group management must consciously avoid spending inordinate time listening to business units or divisional managers, etc. Heavy emphasis should be placed on operating profitability, working together and developing skill of performing in an open and competitive market. So these are all the theoretical aspects so far your transfer pricing mechanism is concerned. You have to refer to your study material also, and you'll be getting the total impact of the transfer pricing from the study materials. Okay, now we are coming to solve the first problem. Your company fixes the interdivisional transfer prices for its products on the basis of cost plus a return on investment in the division. So it is a cost based, but with the cost, a return on investment is actually being added. The budget for division A appears as under fixed assets, current assets, debtors, annual fixed cost of the division, variable cost per unit of product, budgeted volume 4 lakh units per year, desired ROI 28%. Now, what is the question? Determine the transfer price for division A. So, as it is said, your company fixes the interdivisional transfer prices for its product on the basis of cost plus a return on investment in the division. Okay, and we are about to determine the transfer price for division A. So first we are going to look into the investments. We are having fixed assets to the extent of 5 lakhs. We are having net working capital, that is current assets, that is 3 lakhs and 2 lakhs. Okay, and look into the problem, there are no current liabilities. So current assets is the net working capital here, because you see current assets and debtors are also included in the current assets. So other current assets and debtors, that is 3 lakhs and 2 lakhs respectively. So 5 lakhs plus 5 lakhs, we are having total investment of rupees 10 lakhs. The desired rate of return is 28%. Therefore, the profit margin will be 10 lakhs into 28 by 100. It comes to 2,80,000. The desired rate of return is 28% on investments. Investments include fixed assets after depreciation. Number 2, net working capital. In the question, current assets and debtors are given, but current liabilities and creditors are not indicated. So we are assuming that these are assumed to have nil value. Now we are having budgeted volume of 4 lakh units. Then profit margin per unit, the total profit margin we have calculated, that is 2,80,000, and profit margin per unit is going to be rupees 2,80,000 divided by 4 lakh units. It comes to 70 paise. And fixed cost per unit, that is 2. Variable cost per unit is 10. So transfer price per unit will be 12.70. So that is a small problem, but this type of problem may also come in your examination. Now we are coming to a complicated problem, and this problem is very, very important for the examination point of view. Now, Please try to understand. Division A is a profit center. 1 minute, please. Division A is a profit center. Remember, you have to understand what is called profit center, because profit center concept is coming into the picture from the very concept called responsibility accounting. So, in the context of divisional autonomy, the manager of the division is responsible for the investment which is actually being made and return in the form of profit that should be earned, and on that basis the performance evaluation of the division and the manager that can be done. So in the context of responsibility center, we are having cost center, revenue center, profit center, and investment center. Now, division A is a profit center which produces 3 products, X, Y, and Z. Please try to understand the concept. Each product has an external market. So that is also very important. So it cannot be said that these products are intermediate product. Intermediate product means it is not a completed product and which cannot be sold in the external market directly without further processing. That is an intermediate product. But here, what is given, each product has an external market. So that is a very important sentence which is actually being used, and these we are going to take into consideration while fixing the transfer price. So we are having 3 products as it is given X, Y, Z. We are having external market price per unit X 48, Y 46, and Z 40. Variable cost of production in division A 33, 24, 28. Labor hours required per unit in division A 3, 4, and 2. These are the hours which are required to manufacture X, Y, and Z respectively in division A. Now, product Y can be transferred to division B, but the maximum quantity that might be required for transfer is 300 units of Y. Now, as the problem suggests, product Y can be transferred to division B. So, division A is a transferor division. Division B is the transferee division. Okay, so division A is the selling division and division B is the purchasing division. But remember, which product division B requires, that is product Y. And the maximum quantity that might be required for transfer is 300 units of Y. So that is a stricture which is actually being made, that 300 units maximum which are to be transferred. Now the maximum external sales are given X 800 units, Y 500 units, and Z 300 units. Because at the beginning of the problem, it has been mentioned that each product has an external market. Now, instead of receiving transfers of product Y from division A, division B would buy similar product in the open market at a slightly cheaper price of rupees 45 per unit. So, if divisions B's manager is not willing to get the goods transferred, 300 units of Y, from A division, the manager of the division can purchase the so-called product externally from the external source at rupees 45 per unit. It is given in an open market at a slightly cheaper price of rupees 45 per unit. Okay, that is division we can purchase it. What should be the transfer price be for each unit for 300 units of Y if the total labor hours available in division A are 3,800 hours? That is one situation, and the next situation 5,600 hours. Okay, so there are certain restrictions which are already been mentioned. Again, I repeat the question: what should be the transfer price? What should the transfer price be for each unit for 300 units of Y if the total labor hours available in division A are 3,800 hours and 5,600 hours? So these two situations, that is 3,800 hours and 5,600 hours, are independent. Each case is independent. Okay. Now, if I am going to consider that division A is going to sell the three products externally, that is X 800 units, Y 500 units, and Z 300 units, plus 300 units of Y A is willing to transfer. Now, what are the total labor hours that will be required? Please try to understand. Again, I repeat. In this case, it is given external sales that division A can make X 800 units, Y 500 units, and Z 300 units. And it will be requiring 800 units into 3 hours, 500 units into 4 hours per unit, and 300 units into 2 hours per unit. Similarly, with these external sales, if division A is willing to transfer 300 units of Y, then it will be requiring 300 units into 4, that is 1,200 hours. Now, it is given division A, the total hours available, labor hours available, is 3,800 hours. Now, let us see whether labor hours is a key factor or a limiting factor or not. So what is key factor or limiting factor? That is going to limit the production and also the profitability. So if we calculate 800 into 3, that is 2,400, plus 500 into 4, that is 2,000, then 300 into 2, that is 600, okay, and again 300 into 4, that is 1,200, so total 6,200 hours are required. Okay, if all the external sales are required to be made, and with that 300 units of Y, if these are transferred by division A to division B, so total hours requirement will be 6,200 hours. But in the first case, it is said that in division A, only 3,800 hours are available. Hence, labor hour is the key factor or the limiting factor or the principal budget factor. Okay, so we should proceed to solve the problems. Hours required to meet maximum demand. External sales of product A 800 units. Hours required per unit 3. So total labor hours required for the sale of product X by division A, it will require 2400 labor hours. Now, so far Y is concerned, 500 units multiplied by 4, it comes to 2000, and Z 300 units into 2, that is 600. So total comes to 5000. So it is seen that even without any transfer, if division A is going to meet the external sales, it will be requiring 5000 hours, labor hours, but 3800 hours labor are only possible. That is 3800 labor hours are available. So definitely labor is the key factor, or labor hours is the key factor, limiting factor, or the principal budget factor. Okay. Now again, if we consider 300 units of Y, it will be requiring another 1200 hours. Total requirement will be 6200, but only 3800 labor hours are available. So in that case, where labor is the key factor, hence we are going to calculate the contribution per unit and the contribution per labor hour in order to justify which products are good and which products are not to that extent good. So let us start. So we are calculating first contribution per unit. Selling price of product X is given 48. Product Y is given 46 and product Z is given 40. This is given in the question. That is external market price, that is selling price, 48, 46 and 40. Then variable cost, it is given 33, 24 and 28 respectively. So we have deducted variable cost 33, 24 and 28. So that contribution per unit we get 15, 22 and 12. Now labor hours required per unit, as it is given in the question, 3 hours for 1 unit, 4 hours for 1 unit and 2 hours for 1 unit of Z. So we have jotted down labor hours required per unit 3, 4 and 2. Then contribution per labor hour is contribution per unit divided by labor hours required per unit. It comes to 5, 5.5 and 6. So we are going to rank the products Z as the first rank, then Y followed by X. So we have ranked the products Z1, Y2 and X3. So we are not going to stop the external sales of Z and also Y. So least profitable product is X. Let us proceed. Just have a good look. If only 3800 labor hours are available in division A, 300 units of Z, that is maximum. It is given in the problem that the maximum external sales 800, 500 and Z 300 units. Okay. So if only 3800 hours are available in division A, then 300 units of Z maximum, which will take 600 hours. 500 units of Y maximum, which will take 2000 hours. So whatever hours are left, that will be used for manufacturing the least profitable product, that is X. So 1200 hours, so that we can manage the total labor hours available to the extent of 3,800 hours. Now, just look into the note. Labor hours required per unit are given in the question. If 300 units of Y are to be transferred to B division, then 1,200 hours will have to be used for production of Y instead of X. Please try to understand what I am saying. Because internal transfers requires Y product to division B by division A, maximum 300 units. So, labor hours required per unit are given in the question. If 300 units of Y are to be transferred to B division, then 1,200 hours will have to be used for production of Y. And here least profitable product is X. We have to stop production of X to the extent of 1,200 hours and will allocate for the manufacture of product Y for internal transfer. It means division A will sacrifice production of 400 units of X, which are yielding ₹5 per hour. Just look, it is the least profitable product. Okay. So again I repeat, labor hours required per unit are given in the question. If 300 units of Y are to be transferred to division B, then 1,200 hours will have to be used for production of Y instead of X. I think it is understandable to you. It means division A will sacrifice production of 400 units of X, which are yielding ₹5 per hour. Given above is the optimum mix for division A for 3,800 hours. If 300 units of Y are to be transferred to B division with time constraint of 3,800 hours, then additional 300 units of Y have to be produced, sacrificing the production of 400 units of X, which is yielding contribution. Okay, then transfer price of Y will be its variable cost, that is 24 rupees, because this is an outlay cost. You have to incur the variable cost if you are going to transfer the product Y to division B. Variable cost of Y, that is 24, because you are going to transfer product Y to the B division. And with that, there is an opportunity cost. What is opportunity cost here? Contribution relating to X foregone for producing additional units of Y. So, you see, 4 hours are required. Okay, for Y, 4 hours are required. So, contribution relating to X foregone. So, 4 hours that will be required for manufacture of Y, 1 unit, and you have to stop the production of X and then to transfer 300 units of Y. Then contribution foregone in the form of X, that is 4 hours required to manufacture product Y, and ₹5 is the contribution per hour. So in this process, okay, the opportunity cost will be 20. So 24 plus 20, 44 will be the transfer price. Please note, Y takes 4 hours and each hour production of X would have generated contribution of ₹5. So that's why 4 hours into 5, that will be the opportunity cost. Now, we are coming to the next part. If 5,600 hours are available, okay, now maximum time required to meet external sales you see, we are having external sales to the extent of 800, 500 and 300 units. Okay. So what we are doing in the second case, if 5,600 hours are available, maximum time required to meet external sales, 5,000 hours. Okay. Hours now available as per the question is the second independent point, that is 5,600 hours. Okay. It means 600 hours can be easily used for the production of Y, and transfer price will be variable cost only. That is 6,000 hours divided by 4 hours into 24, that is 3,600. Y takes 4 hours per unit. So for producing additional 150 units, production of X will be disturbed. So 150 units of Y into rupees 24, 3,600, and opportunity cost, that is contribution of X units foregone, 600 hours into 5, that is 3,000, that is 6,600. So total price for 300 units, 10,200, and average transfer price should be rupees 34 per unit. Okay. So transfer price, what we have fixed so far, 3,800 hours are concerned, the transfer price will be, that is rupees 44, variable cost plus contribution foregone. But when 5,600 hours are available, okay, then what we have calculated, the transfer price, that is, because for 150 units there is a key factor or limiting factor. Okay, 300 units we are going to transfer, but since 5,600 hours are available, then for only 150 units of Y, okay, we are going to consider, that is 150 units of Y at the rate 24, that is 3,600, contribution of X units foregone, 600 hours into 5, that is 3,000, total is 6,600. So total price for 300 units will be 10,200. Therefore, average transfer price should be 10,200 divided by number of units. It comes to rupees 34 per unit. And this 3,000 is nothing but contribution per hour of X foregone. Now, you tell me whether you have understood this or not, because I'm just going to make a synopsis. Just a minute. Let me see. Now, what I am saying, if there is a key factor or limiting factor, then we are going to consider the key factor or the limiting factor into consideration, and we are going to set out the transfer price accordingly. So in the given case, what we have seen that, let me just summarize. We have seen that only 3,800 hours are available, but total requirement will be for meeting external sales 5,000. So there is a key factor or limiting factor. Hence, we should go to calculate the contribution per unit and also contribution per labor hour. And accordingly, you are going to rank the product. And here we have ranked Z1, Y2 and X3. Hence, in order to transfer Y to the extent of 300 units, we have to withdraw product X having least profitability, and accordingly, we are going to have the concept of variable cost because we are transferring the product Y. Hence, variable cost of product Y is 24, and there is an opportunity cost because Y requires 4 hours, and you are going to lose a contribution of rupees 5 per hour if product X is withdrawn from the market. Hence, the transfer price will be 44. But if 5,600 hours are available, then only for 150 units of product Y, there is a key factor or limiting factor. And on that basis, we are going to consider that is we are going to consider that is variable cost, because for 150 units there will be a loss of contribution because 5,600 hours are available. So for 150 units, the variable cost of Y is 24, that we have to incur, and contribution of X units foregone, that is for 600 hours into 5, it comes to 3,000. So total is 10,200 and average transfer price should be rupees 34 per unit. Okay. Now let us come to this problem, and after completing this, we'll be going to start marginal costing. Just have a good look. Please allow me 2 minutes and I'll be discussing this problem, and once we complete this, let us go to marginal costing. Just have a good look. Please allow me 2 minutes. Now look into the problem. A company has two divisions, X and Y. Division X manufactures a component which is used by Division B to produce a finished product. For the next period, output and costs have been budgeted as follows. Component units Division X for 50,000. Finished units Division Y 50,000. Total variable cost is 2 lakh 50 and 6 lakhs. Fixed cost 1 lakh 50 and 2 lakhs. So the fixed costs are separable for each division. Mind this, because it is a specific fixed cost and it is given the fixed costs are separable for each division. You are required to advise on the transfer price to be fixed for division X component under the following circumstances. Number one, division X can sell the component in a competitive market for rupees 10 per unit. Division B can also purchase the component from the open market at that price. Okay. So the idea is we have to advise the company on the determination or fixation of the transfer price for division X component, and situation is division X can sell the component in a competitive market for rupees 10 per unit. So there is an external market available for the components and X can directly sell to the market at rupees 10 per unit. On the other hand, also division B can also purchase the component from the external market, that is also called open market, at rupees 10 per unit. Now let us proceed. Now, definitely the concept is transfer price decision can be taken on the following basis. Transfer price, that is additional outlay cost in the form of marginal cost plus opportunity cost. Okay, because variable cost, so far division X is concerned, it is given 2,50,000 and division Y is given 6 lakhs. Now what we are going to consider, that is marginal cost is rupees 2,50,000 divided by 5,000 units. That is variable cost 5. Okay, then marginal cost 5 and opportunity cost is also rupees 5. That is a contribution per unit. That will be foregone. That is the opportunity cost. So opportunity cost rupees 5 is computed on the basis that the division A will sacrifice rupees 5 if they sell the product to division Y. So transfer pricing decision or transfer price will be marginal cost plus opportunity cost, that is rupees 10. Now we are coming to our second part. As per the situation mentioned in one above, and further assume that division Y currently buys the component from an external supplier at the market price of rupees 10, and there is reciprocal agreement between the external supplier and another division Z within the same group. Under this agreement, the external supplier agrees to buy one product unit from division Z at a profit of rupees 4 per unit to that division for every component which division Y buys from the supplier. So little bit critical. Okay, so in that case, we are going to have, in this situation, the transfer price will be worked out as transfer price is equal to marginal cost plus contribution foregone plus profit foregone by division Z, that is 5 plus 5 plus 4, that is rupees 14. In situation 2, if division Y purchases from division X, it will not purchase from external supplier. Hence, the supplier will stop purchasing from division Z, which will result in a loss of profit to division Z at the rate rupees 4 per unit. And therefore, this amount will be recovered from the transfer price. So, let us repeat once more. As per the situation mentioned in one above, and further assume that division Y currently buys the component from an external supplier at the market price of rupees 10, and there is reciprocal agreement between the external supplier and another division Z within the same group. Under this agreement, the external supplier agrees to buy one product unit from division Z at a profit of rupees 4 per unit to that division for every component which division Y buys from the supplier. So if there is a transfer from division X to division Y, then there is no question of any purchase from the external supplier, okay, and division Z's profit rupees 4 per unit, that will be sacrificed, okay. So if division Y buys from the supplier, so that's why in situation 2, if division Y purchases from division X, it will not purchase from external supplier. Hence, 5 variable cost, 5 opportunity or contribution foregone, plus rupees 4 profit foregone, transfer price will be rupees 14. Hence, the supplier will stop purchasing from division Z, which will result in a loss of profit to division Z at the rate rupees 4 per unit. And therefore, this amount will be recovered from the transfer price. Hope you have understood, and we are leaving these transfer pricing issues and we are coming to marginal costing. Now let us proceed. Now we are about to start marginal costing, which is also called variable costing. Now, actually in marginal costing, in your group 2, okay, now I'm sorry, in marginal costing, especially the paper management accounting is concerned, lot of emphasis should be given on the very perception of marginal variable costing. Now, we are going to have certain discussion, that is explanation of the concepts of marginal cost, then marginal absorption costing. Then there will be a difference between or distinction between absorption costing and marginal costing. And obviously there are certain advantages and limitations of marginal costing. The most important concept is preparation of income statement under absorption costing and marginal costing. That is a very, very important question. So for the examination point of view is concerned, that is preparation of income statement under absorption and marginal costing. Then different methods of determining cost behavior, cost volume profit, that is CVP analysis and its limitations, and curvilinear break-even analysis. Then there is a concept called cost indifference point. The cost indifference point is that point where, say there are two alternatives, you can select any of the two alternatives which will give you the same benefit. So when I am talking about marginal cost in economic point of view, so for the economics is concerned, marginal cost means the extra cost of producing one more unit. But so far the marginal costing or the variable costing is concerned, by marginal cost we means variable cost of production. Now marginal costing is a costing technique. It is not a method. Now at this juncture, you should know how to make a difference between methods and techniques. Methods are methodology for arriving at the total cost and cost per unit using different costing approach, namely job costing, batch costing, contract costing, operation costing, operating costing, multiple costing, so on and so forth. But marginal costing is not a method but technique of, it is a technique which actually make a distinction between fixed cost and variable cost. Fixed costs are separated out as a period cost, and we should go for calculation of contribution by the total contribution and deducting the fixed cost as a period cost, we'll get the profit. In marginal costing, we are going to consider only the variable cost and fixed cost are separated out and termed as a period cost. Now, this thing I have already explained, that is marginal cost in cost accounting means variable production cost, that is the cost which tend to vary in direct proportion to changes in the production volume. At this point, you should know two important phenomena. Total variable cost is variable, but per unit variable cost is constant. And again, total fixed cost is fixed, but per unit fixed cost is variable. I think you know this. So marginal cost in cost accounting means variable production cost, that is the cost which tend to vary in direct proportion to the changes in the production level. If an extra unit of output is produced, the cost which could be incurred for producing this extra unit will only be marginal, that is variable cost, since fixed costs remain constant. Now, marginal costing is a costing technique in which only variable manufacturing costs are considered and used while valuing inventories, mind this, and determining cost of goods sold. That is, only variable manufacturing costs are considered product costs and are allocated to products manufactured. These costs include direct materials, direct labor, and variable factory overhead. Fixed factory or manufacturing overheads are not considered product costs and are not used to value inventories and determine the cost of goods sold and are excluded from the cost of product. Fixed manufacturing costs, as I have said, are treated as period cost. It is fixed for a particular period. But remember, there is no fixed cost in the long run. All costs tend to vary in the long run. Okay, so fixed manufacturing costs are treated as period cost in marginal costing, that is, costs which are a function of a time rather than of production. In marginal costing, fixed manufacturing overheads are written off to the PL account in the period in which they are incurred. So that is about your marginal costing. Now we are coming to absorption costing. Absorption costing, also known as full costing, is a costing technique in which all manufacturing cost, variable and fixed, is considered as cost of production and is used in determining the cost of goods manufactured and inventories. All manufacturing costs are fully absorbed into finished goods. So that is your absorption costing. Now, a distinction or difference between marginal cost and absorption costing is of much importance. Now, marginal costing and absorption costing differ from each other on the view of certain perspectives, or marginal costing and absorption costing differ from each other in the following respects. Number one, cost element in product cost. Please try to understand. Marginal costing and absorption costing differ only in the treatment of fixed factory manufacturing overheads in the accounting records and financial statement. In both the costing techniques, it is agreed that selling and administrative expenses, whether variable or fixed, are period cost, and these costs are not treated as product cost, with the result that selling and administrative expenses are not included in the cost of inventories and cost of goods sold. This is a very, very important point. Again, I repeat, in both the costing techniques, it is agreed that selling and administrative expenses, whether variable or fixed, are period costs, and these costs are not treated as product cost, with the result that selling and administrative expenses are not included in the cost of inventories and cost of goods sold. Similarly, it is also agreed that variable manufacturing cost or product cost, that is cost to be charged to the product, the disagreement between the two is only in regard to the treatment of fixed manufacturing cost. So marginal costing and absorption costing their result, that is profit, will be different due to the fixed manufacturing cost, which are included in absorption costing but not in marginal costing. Then comes inventory values. You see, there will be definitely certain inventory in the form of raw material, then work in progress and finished goods. Now, I'm talking about finished goods inventory. Marginal costing and absorption costing do influence inventory values differently. The value of inventories under marginal costing is relatively at a lower figure, as inventories are determined in terms of only variable production cost. So this is a vital point. In absorption costing, the value of inventories is comparatively at a higher figure because it considers fixed factory overhead also besides the variable production cost. Then difference in net income, the treatment of fixed factory overhead brings difference in the net income figures in the two costing techniques. The magnitude of any difference is net income is a function of fixed manufacturing cost per unit and the change in inventory level. The question of difference in net income has been further explained as under while discussing income statement under absorption costing and marginal costing. Now, gradually we are coming to how income statement is actually being prepared under absorption costing. Under absorption costing, all costs are divided into three categories. Please try to understand. Manufacturing, selling, and administrative cost. In the income statement, all manufacturing costs, variable and fixed, are subtracted from the sales revenue to get a gross margin or gross profit on sales. And selling and administrative expenses, fixed and variable, are deducted from gross margin to arrive at the net income. It should be clearly understood that fixed manufacturing overhead are charged to units produced on the basis of per unit fixed manufacturing overhead rate obtained by dividing the standard fixed manufacturing overhead by normal output level. So we are going to get per unit fixed manufacturing overhead, and how we are going to get standard fixed manufacturing overhead divided by normal output, that is capacity. If production is above or below the normal or standard output, adjustments are made for volume, that is capacity variances. That we are going to discuss in standard costing with reference to fixed overhead. If the volume or capacity variance is favorable, that is over absorption, actual production being higher than normal capacity production. The amount of over absorption is deducted from the total cost of goods manufactured and sold. If the volume or capacity variance is unfavorable, that is under absorption, actual production being lesser than the normal capacity production, the amount of under absorption is added to the cost of goods manufactured and sold. And we are coming to the pro forma. Just have a good look. So income statement under absorption costing, how do we get? We are taking sales, then we are deducting manufacturing cost comprising of variable production cost in the form of direct material cost, direct labor cost, and variable manufacturing overhead. And number two, fixed factory, that is manufacturing overhead. Then we get cost of goods manufactured. Then we are going to add beginning inventory, that is cost of goods available for sale. Then we get add beginning inventory, then we get cost of goods available for sale. Then we deduct closing inventory, that is the cost of goods sold. Then we are going to take over or under absorption or under applied factory or manufacturing overhead. Over absorption is deducted and under absorption is added. Once we do that, we get cost of goods sold at actual. And after deducting these, we get gross profit on sale. Then we are going to get, deduct fixed selling and administrative expenses and variable selling and administrative expenses to get the net income. So mind this. So in absorption costing, the income statement that I have shown, that is actually being followed while arriving at the net income. On the contrary, so for the income statement under marginal costing is concerned, under marginal costing, only variable cost of production, that is direct material, direct labor and variable manufacturing, are subtracted from sales revenue to determine a balance which is known by different names such as marginal contribution, marginal income profit, marginal revenue, marginal balance, profit pickup, etc. So you just remember contribution. All fixed costs and variable selling, distribution and administrative costs are deducted from this balance to arrive at the net income. Since fixed manufacturing costs are not charged to products under marginal costing, there can be no volume capacity variance. Okay. Marginal contribution or marginal income under marginal costing is greater than the gross profit or gross margin under absorption costing. Now we'll be giving the figure 2 depicts a pro forma income statement prepared under marginal costing. I'm going to show you under marginal costing, fixed manufacturing overhead is excluded, and therefore inventory values are lower than inventory value computed under absorption costing. Income may be higher or lower depending upon whether inventories are built up or it has been disposed of. That is, the income statement under absorption costing may reflect higher profit if production is more than the normal capacity production and also lower sales has been made. This happens because above normal capacity production has over-absorbed its actual fixed manufacturing overhead. Absorption of the full costing and marginal costing influence differently gross profit, net profit and inventory values of different months and periods. Okay. Now we are coming to income statement. So for the marginal costing is concerned, we are having sales, then we are deducting variable production cost, that is direct material cost, direct labor cost, then variable manufacturing or factory overhead, then cost of goods manufactured. At beginning inventory, cost of goods available for sale, less closing inventory, then we get cost of goods sold, and after adjustment, we get marginal contribution. Less fixed manufacturing overhead, then variable selling and administrative expenses, fixed selling and administrative expenses, will get net income. So, compilation of net income or arriving at the net income under marginal costing and absorption costing, as I have explained, is different. Now, I'm just taking a small data to make you understand. Normal capacity 20,000 units per annum. Variable cost, direct material, direct labor and variable factory overhead per unit ₹6. Fixed factory overhead ₹25,000 per month or ₹1.25 per unit at normal capacity. Fixed selling and administrative expenses are ₹5,000 per month. Variable selling and administrative expenses are ₹1 per unit sold. Sale price per unit are ₹10. Actual production, sales and inventories units are, just have a look. First month, second month, third month, and fourth month. Units is the beginning. In the first month, there is no units. Second month, no. Third month, 3,000, and fourth month, 1,000. Next, units produced 17,500, 21,000, 19,000, and 20,000. Units sold 17,500, 18,000, 21,000, and 16,500. Units in closing inventory, first month nil, second month 3,000, third month 1,000, and fourth month 4,500. So, firstly, we are going to prepare the income statement under absorption costing. So, we are having 4 months, that is first, second, third, and fourth. Sales we are having, then variable cost per unit rupees 6 multiplied by number of units, then fixed factory overhead at the rate rupees 1.25. So cost of goods manufactured after adding all, that is variable cost per unit rupees 6 and fixed factory overhead at the rate rupees 1.25. So after adding this variable cost per unit and fixed factory overhead 1.25, we get 21,875. I am coming one by one. Then we are adding beginning inventory. Beginning inventory was not there. Then cost of goods available for sale, it is 126,875. Ending inventory is also not there. So cost of goods sold is 1,26,875. Then over or under applied factory overhead, I'll show you how it is calculated. Over or under applied factory overhead, first month 3,125. So after adding this, cost of goods sold at actual 1,30,000. So if we deduct cost of goods sold at actual from the sales, we have the gross profit on sales 45,000. Selling and administrative expenses, fixed and variable 22,500. Then net income for the month comes to 22,500. Now just look into the notes. In absorption costing income statement, fixed factory expenses are included in the unit cost and also in the inventory values. Okay. Now, ending inventory will be calculating afterwards. In first month, rupees 3,125 is under absorbed factory overhead due to production less than normal capacity and should be added to the cost of goods sold. Just have a look. So actually normal capacity is 20,000 units and units produced is 17,500. So 20,000 minus 17,500, it comes to 2,500 into 1.25. 1.25 is the, you see, 1.25 is the fixed factory overhead. That is 25,000 per month or rupees 1.25 per unit at normal capacity. So you are supposed to manufacture 20,000 units, but in the first month You have manufactured only 17,500. So there is a difference in units, that is 20,000 minus 17,500, that is 2,500 units. We have produced less multiplied by 1.25. So it comes to 3125. That is the under absorption. Now coming to the second month. Second month sales is given 1,80,000. Variable cost per unit rupees 6. Fixed factory overhead at the rate rupees 1.25. Okay, but in second month unit produced is 21,000. Remember. So 21,000 into rupees 6, it comes to 1,26,000, the variable cost. Then fixed factory overhead at the rate rupees 1.25, that is, it comes to 26,250. How? 21,000 multiplied by 1.25, that is 26,250. Then you get cost of goods manufactured 152,250. There is no closing inventory, hence there is no question of any beginning inventory. So cost of goods available for sales, that is 1,52,250. Ending inventory we are going to calculate, just have a look now, 21,750. Cost of goods sold 1,30,500. Then there is an over absorption. Over absorption means you are supposed to manufacture 20,000 units, but you have manufactured 21,000 units. So 1,000 into 1.25, you get 1,250. Over absorption, that should be deducted. Then cost of goods sold at actual, we get 1,90,250. Then sales minus cost of goods sold at actual, gross profit on sales we get 50,750. Then selling and administrative expenses, fixed and variable, is 23,000. So net income for the month we get 27,750. Now here we have actually deducted ending inventory as 21,750. How do you get ending inventory? You see, 21,000 produced, 18,000 sold. So definitely 3,000 units in closing inventory. So 3,000 divided by 21,000 into 1,52,250, we get 21,750, and that 21,750 we have written under ending inventory. Hope it is clear. Now we are coming to third month. We are having a sales of value is 2,10,000. Variable cost per unit rupees 6 per unit into number of units manufactured. Factory fixed factory overhead 1.25. Similar calculation 23,750. So cost of goods manufactured we get 1,37,750. Last month closing inventory will be the next month's beginning inventory. Okay, so last month's, second month's closing inventory will be the next month's beginning inventory. That we have taken 21,750, and after adding we get cost of goods available for sales 1,59,500. Ending inventory, we are going to value, just have a look. 1000 is ending inventory divided by 22,000 into 1,59,500, we get 7250. So we get 7250. Then after adding, we get cost of goods sold. Then over or under applied factory overheads, it is 1250, same manner. That is 1000 into 1.25. That is 1250. So we get cost of goods sold at actual 1,53,500. Gross profit on sales 56,500. Less selling and administrative expenses, fixed and variable 26,000. So net income for the month we get 30,500. Similar manner, we are going to take sales 1,65,000. Variable cost per unit ₹6, it comes to 1,20,000. Fixed factory overhead 25,000. Cost of goods manufactured 1,45,000. Then third month's ending inventory will be the fourth month's opening inventory, that is 7250. After adding, we get 1,52,250. Less ending inventory, we value in the same manner. That is 4,500 divided by 21,000 into 1,52,250. It comes to 32,625. Then we get cost of goods sold. And there is no under or over absorption because units produced 20,000, which is the normal capacity also 20,000. So there will be no question of any under or over absorption. So cost of goods sold at actual, we get 1,19,625. Then after deducting it from sale, we get gross profit on sales. Then selling and administrative expenses, fixed and variable we deduct. So we get net income for the month. So ending inventory, I have already told you how we have valued. In first month, ₹3,125 is under absorbed factory overhead due to production less than normal capacity and should be added to the cost of goods sold. In the second month, ₹1,250 is over absorbed due to higher production and has therefore been subtracted. In the third month, ₹1,250 under absorbed and has been added back to the cost of goods sold. In the fourth month, production is at normal capacity and there is no under or over absorption. Hope you have understood. Now we are coming to the income statement under marginal costing. Please try to understand how income statement is actually being prepared under marginal costing. So we are having 4 months, first, second, third, fourth. Sales we have jotted down. Then variable production cost, only the variable manufacturing cost will be 6 per unit. Okay. So cost of goods manufactured, we got beginning inventory is nil. So cost of goods manufactured is cost of goods available for sale. Closing inventory is not there. Cost of goods sold is 1,05,000. Sales minus cost of goods sold, we get contribution, less fixed overhead, then less fixed selling and administrative expenses, then variable selling and administrative expenses. So total fixed cost and non-manufacturing variable cost, 47,500, that is 25,000 plus 5,000 plus 17,500. So net income for the month, 22,500. In the second month, we are having a sales, then variable cost on the number of units produced, cost of goods manufactured, no beginning inventory, closing inventory is 18,000, that is 3,000 into 6, that is 18,000. 3,000 is the closing number of units multiplied by variable cost. It comes to 18,000. Then cost of goods sold, we get 1,08,000. After deducting sales and cost of goods sold, we get contribution less fixed factory overhead, 25,000. Fixed selling and administrative expenses, 5,000. Variable selling and administrative expenses, 18,000. So that 25,000 plus 5,000 plus 18,000, total fixed cost and non-manufacturing variable cost comes to 48,000. After deducting, we get net income for the month. Similarly, in the third month, we have taken sales, then variable manufacturing cost, cost of goods manufactured. Last year closing is this year opening. We have added cost of goods available for sale, less closing inventory, 6,000. It is based on variable cost, that is 1,000 into 6, that is 6,000. Then we get 1,26,000. Sales minus cost of goods sold, we get contribution, less fixed factory overhead, 25,000, 5,000 and 21,000. Total fixed cost and non-manufacturing variable cost, 51,000. Deducting from contribution, we get net income for the month. Accordingly, in the fourth month, we are having sales 1,65,000. Variable manufacturing cost, number of units multiplied by 6, that is 1,20,000. Cost of goods manufactured, 1,20,000. Last month's closing is this month's opening, 6,000. It comes to 1,26,000. Closing inventory, 4,500 units multiplied by 6, that is variable cost, 27,000. Cost of goods sold, 99,000. Contribution, 66,000. Less factory overhead, 25,000. Fixed selling and administrative expenses, 5,000. Variable selling and administrative expenses, 16,000. So total fixed and non-manufacturing variable cost, 46,500. So net income for the month, we get 19,500. Now, under marginal costing, fixed factory manufacturing overhead costs are not included in the product unit cost and cost of inventory. Valuation of closing inventory is based on number of units which are lying in closing stock multiplied by the variable cost per unit, and accordingly it is 18,000 in the second month, third month 6,000, fourth month 27,000. Remember, the question of under or over absorption of factory overhead does not arise under marginal costing. So mind this. Now, a comparison of the income statement leads to the following conclusion. Under variable costing, the closing inventory is costed at a small figure because only variable production costs are charged to the product. Both costing report the same amount of profits in periods in which production and sales are equal and there is no inventory change first month. This is because the amount of fixed factory overhead cost charged to the period was the same in each case. Under marginal costing, rupees 25,000 was deducted from sales as period cost. Under absorption costing, rupees 25,000 was charged to the sales in two parts. Rupees 21,875 as part of the cost of sales and 17,500 units at the rate rupees 1.25 and rupees 3,125 as unfavorable volume capacity variance. When inventory of manufactured goods fluctuates from period to period, net income will differ somewhat under the two methods because absorption costing requires that part of the period cost to be included in inventory whereas marginal costing excludes period cost. Therefore, when production exceeds sales, the inventory is increased. The net income reported under absorption costing is higher than the reported under variable, that is marginal costing. This follows because under absorption costing, a proportion of the fixed cost budgeted for the period is shifted to the following period in the closing inventories. Whereas under marginal costing, the total fixed costs are charged against income. This is clear from comparing the net income of the second and fourth month. When sales exceed production, the inventories are decreased. Marginal costing shows a higher profit because only current period costs are being charged against current revenues. Whereas under absorption costing, the period costs previously included in inventory are now being charged against current revenues. So these are the things actually what I have said. Just have a look. Under marginal costing, net income for the first month is 22,500. Whereas in absorption costing, net income is 22,500. Now the question arises why? Okay, both having same profit. Just have a look. Okay, now in the second month, under marginal costing, we are having 27,750 and marginal costing 25,000. First case profit is same because there is no question of any beginning or closing inventory. Second one, definitely there is a closing inventory, and due to this marginal costing profit is 25,000, but absorption costing profit is 27,750 due to the existence of closing stock or closing inventory, and it is valued at full cost, variable plus fixed. In the third month, it is 30,500 under absorption, and it is 25,000 because more closing stocks are there in the third month. And in the fourth month, absorption costing profit is 23,875 and marginal costing profit is 25,000 because that is 19,500 because existence of more closing stock. So hope you have understood why there are disagreements of profits in marginal costing and absorption costing. So for the presentment or presentation of income statements are concerned. Now, hope you have understood whatever I have explained. So in the next class, we are going to cover the marginal costing with certain decision-making aspects. Okay. And after that, we'll be having standard costing, then learning curve. Okay, and responsibility accounting. So, hope you have understood what I have said. It is clear to all of you, and we are closing today. Wish you all the best, and thank you for your participations. Thank you, and good luck.
Thank you, sir.
Thank you.